Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 28th of May. The bull market in America and also in Europe rolled on, not so much in Australia, but it all remains pretty positive despite the really negative media reporting that's out there at the moment. So let's jump in and have a look at the action. The S&P managed to gain 34 points on the week, so that rather sudden dip that occurred the Wednesday before last was just a one-day wonder, and that gain in the S&P represented 1.5% on the week, so pretty solid. I guess my observation about what's happening in America is that the trend just keeps grinding higher, and it's the same in Europe as well. There's no real euphoria. There's plenty of skepticism, as we've seen from all the way from 2009. People have been expecting the market to fall apart again. So these are not conditions that typically lead towards a top in the market. The people that are negative on the market are using the fact that it's gone on for so long as a reason. Well, that holds no water in my view. They use valuation as a reason, and some of the valuation methodologies are really just cherry picking the data to suit. They use all sorts of different means of proving that the market really should turn over and go down. But the fact is, it's still grinding higher, and that's really all that we need to know. Now, large cap technology stocks, I've got a bit of a divergence of data and thought here. For large cap technology stocks, so Apple and Amazon and Google and Facebook and all those stocks are doing better than small cap stocks. And there's one way of looking at it, which suggests that that process is increasing, which is not good for the health of the market. However, that condition can exist for quite some period of time. So it doesn't necessarily mean that we're near a market top. But on the other hand, the cumulative breadth numbers, or the advanced decline line, as it's called in America, is setting new highs. So that means that there is still a large number of stocks that are still advancing and setting new highs. So those two observations kind of contradict each other a little bit. And so I'm just going to remain neutral on that point, and I'll show you the price charts in a minute. Now, the VIX, of course, is still way down. We're still in single digits. We're below 10. It's almost unheard of, and it's almost unheard of for this length of time. But go up to the first point, and that is there's still no euphoria. There is still lots of skepticism. And so this is just not the kind of environment where markets start to fall apart because all the money's in. Now, you've just got to expect a correction, even a short-term, fairly mild correction. I mean, markets just do not go up in straight lines. So I'm expecting a correction, but something that's pretty mild. And then I would expect that, given all that I see at the moment, both in terms of economic data and also the charts themselves, that we're going to see a further advance, and that 2,500 points is absolutely in play now. And who would have thought that 6 or 12 months ago? Bull markets are run on the earnings, the estimated future earnings, and then also as those earnings come through. The consensus earnings estimates for the S&P are for them to rise by 12% year on year, so that's into 2018. So the future outlook remains very positive. And 2017 is heading for 14% growth year on year at this point in time. So right now, we've got some of the highest growth in profit results that have ever been seen, and the forward estimates are still really solid. So there is absolutely no reason why this trend cannot continue higher. I would be very circumspect about people who are cherry picking the numbers to suit. Now, I was asked a question by someone the other day that supposedly there'd been no growth in earnings in the S&P since 2010. I can tell you that across the S&P, that fact is blatantly incorrect. But secondly, you also need to be aware of the sectors. Now, the earnings were pretty lackluster for a few years there in America, but that was because the energy sector got absolutely murdered. And the energy sector earnings were down substantially, and that dragged down the whole S&P. But what if you're not trading energy? What if you're in technology or healthcare or some of the other industrials, some of the other sectors where the earnings growth has been really solid? Then you shouldn't be looking at the numbers for the S&P as a whole, because if that's not what you're participating in, then what difference does it make? So be aware, people who are just cherry picking the numbers. It creates a nice headline for them. It creates a good story, but it completely misleads you as to what's going on. So let's take a look at the American market. This is the S&P. So the green box I've left here, it's been there now for some couple of weeks. We dipped into the middle of that range, and that was largely a one-day wonder. That was Wednesday, the 17th of May, and then the market took straight off again, and we're now at new all-time highs above 2,400, so we've broken that resistance. Now, it's really hard to nominate an area where the market may come back to, because we've just broken to new highs, so I don't know how far this might go before we do get a mild correction. But I guess there's several lines in the sand that I would be looking at. As you can see here, we've got higher lows and higher highs, which is the definition of a trend. So first of all, I wouldn't want to see the index particularly fall below this level, which is 23.55. But look, if it did, it wouldn't bother me that much, because short-term lows often get breached in a minor way if this market, for instance, was to go into some sort of sideways consolidation for a while. So that would be my first line in the sand. My second line in the sand would be here, because that is a little bit more significant if that low got taken out. So that's 23.20. And then if there was an event, which is probably likely to be one that's a bit more, let me just get the right indicator. So if we did get an event which was a bit more sentiment driven, could be another Trump tweet or something that upset the market, then we may get a retracement of this whole run that started in November, just before the US election, in which case we're looking at 22.93. But look, any of those three scenarios do not change the advance of the bull market in my view. I think now that with what we're looking at, in the absence of some event in perhaps North Korea or something of that nature, I'd be very surprised if we saw 22.90. We may get a little break of 23.55. So I would be looking at this point in time. Let's just whack a rectangle in here. This would be a retracement area that I would be looking at, worst case scenario at the moment, on everything that we can see, and that's pretty mild. So the message would be to to continue buying the dips. Aussie stocks. Sorry, I'll just go back to these charts. I just wanted to make one other point. Let's look at the Nasdaq index. So you can see the Nasdaq continuing to roar ahead. The 50-day moving average is still widening from the 200, and the price is well above the 50. So that trend is accelerating, and that's down to the Apples and the Amazons and Facebooks, etc. That can't continue, and I think at some point we'll get a little bit larger correction of this move that may perhaps breach this 50-day moving average. But at the moment, it's very, very powerful indeed. Now compare that with the Russell 2000, and you can see the Russell has really just been going sideways since December. So when you look at that, you can say, well, the small caps are definitely underperforming the large cap technology names. But bear in mind the advanced decline line, which doesn't lie, that's just the number of stocks advancing compared to the number of stocks that are declining. So there's nothing subjective about that. Then that continues to set new all-time highs. So whatever is going on in the market that's causing the Russell to lag relatively, it's nothing serious at this stage. And just while I'm here, the US dollar is really in a downtrend, as you can see, and we've broken out of that declining wedge that we had, and I'm looking at perhaps levels down here below 96 and possibly even down to 93. And if that continues, then obviously that's going to be good for commodity prices. The Aussie dollar steady at 74.5. Was a volatile week. The currency moved around by more than a cent, but it remains within the lower trading band. We'll look at that in just a minute. Now, the ASX 200 index compared to elsewhere around the world was disappointing. It rose 24 points for the week, but finished rather negatively. And certainly the downgrade by one of the ratings agencies on China certainly had an impact. But again, I think that's, it's probably overdone, and people have been trying to poke holes in the China story now since 2013-14, and China keeps rolling on, and I'll remain in that with that assumption until we actually see some data that suggests that China's in trouble. The one part of the Chinese economy that is going well, however, is their transition from a manufacturing export economy to a consumer economy, and that transition is going along quite well. Now, no one in their right mind would expect that such a massive economy could make such a huge transition in its function without some speed bumps, and no doubt there'll be some speed bumps along the way. But I think these people that have been trying to talk China down for the last 3 years are just doing it on hope rather than on factual evidence. There is a lack of trends in the Australian market, and that remains the feature. It's frustrating, that's for sure, because a lot of good stocks are just languishing. And even the very best small and mid-cap stocks that are being held down by fears over our economy. I spent a great deal of time analysing all sorts of small and mid-cap companies. I've got a very defined template that I use. It's one that I think is extremely robust. And over the longer term, it shows, which companies are going to do well in the economy. But at the moment, even those companies that have done really well for the last 2, 3, 4, 5 years and are still doing well, but their prices are struggling. The market sentiment here is it's really not conducive at all. So let's look first of all at the Aussie dollar. So we had a big picture range, which was 68.5 to about 78.5. And then that breaks down into two smaller ranges, one here between 75 and 78, and then a lower one between 75 and say 71. We've dropped out of the top range, we've dropped into the lower range, we've gone back up, tested that, the bottom boundary of that upper range, and sliding away again now. But if the US dollar does continue down, then obviously that's going to continue to put some upward pressure on the Australian market. So with respect to Australia, my advice is that you either go for Australian stocks that are globally facing businesses. The majority of their revenue and an increasing amount of their revenue comes from overseas, because I have some real concerns about the Australian economy. Or the alternative is, look, just go global and be done with it. The number of opportunities and the strength of the fundamentals really dictates that a certain proportion, and I think a significant proportion of your portfolio, should be overseas. Turning now to precious metals, gold was up by $12 on the week, was quite positive, finished at $12.68, and of course managed to hold its ground above the key 200-day moving average. Is it coiling for a move higher on a big picture level? I think so. I'm not overly bullish about it in the short to medium term, but it could well be setting up a bigger picture wedge pattern that could break to the upside. And as I mentioned, the US dollar is trending lower, so that's helping as long as that continues. But I think one of the reasons that that gold was up as much as it was in the week was that what we've seen, the liquidation in the futures market for gold reversed. We saw a fairly significant increase in the number of speculative long gold contracts. So they went up, and we also saw a fair amount of short covering as well. The number of short contracts reduced. So just that physical practicality of what's happening in the futures market certainly helped drive the precious metals price higher. Silver was a bit different. Silver coming off a much more extreme level of speculative longs. There was really hardly any increase in longs through the week. The rise in silver was really about the short covering. So that indicates not as much confidence. The people that were short the futures market have covered. They've sold out of their positions. They've taken profit, but there wasn't too much enthusiasm to increase the longs. And so hence the move in silver was a little bit more muted. Now, precious metals stocks, buying the dip still looks a reasonably solid bet for mine. It's a volatile sector, so it's really hard to pick the bottoms, but if you progressively work your way into that sector, then buying the dips looks fairly solid at the moment. But just remember your portfolio balance. Don't get it in your head that gold and silver are going up, and therefore you can throw a large amount of your portfolio at that sector. Decide what a level is that's comfortable for you over the longer term, and work your way steadily towards that level. So let's take a look at gold and silver. First of all, silver. So a nice rebound over the last couple of weeks from those lows in the low $16 area. We made it back and closed at $17.39. So coming back from oversold. This is gold. Had a quite a healthy session on Friday. As you can see, the red line is the 200-day moving average. We've been mucking around above and below it for some time, but you'll notice that we're now spending more time above the 200-day moving average. So I see that as a positive, and you've got to acknowledge when you look at the price chart that we have an uptrend. We've got higher lows and higher highs. So there's no question that that gold is in an uptrend. So we'll see what the next week brings. Other commodities, copper was steady. Crude oil dipped sharply. It was up around 51, dipped to 47. A very, very sharp dip, and then recovered on Friday to finish just under the 50 mark. Now that sudden sell-off was some sort of reaction to what OPEC were doing. I think it was probably a little bit overdone, but look, the move certainly had a lot of power behind it. It looks a bit impulsive to me, so I'm really favouring more downside in the oil price over time. And if oil were to get down to 45 and below, I think that'd be a great time to start putting your toe in the water on energy stocks. The demand for oil remains strong, so that's not an issue. It's really just a supply side issue. But what's really happening here is that US production increases. They've got their costs down in shale oil to such a degree now that they can operate very profitably down at these low levels below $50. And so as OPEC is cutting, then US production is increasing, and the cost of US production is a lot lower than many of the OPEC member nations. So that's certainly a real negative for a lot of those countries, that's for sure. There's the spot copper chart. And just to round it out on the current positioning, the economic and profit outlook, particularly in Europe and America, is still really positive. So I just find it very, very difficult to be negative at the moment. Ignore the political rhetoric. Most of the media in America are trying to sabotage Trump. So if you take the media and their bias as an indication of what people are really thinking in America, then I think you're going to be misled. Trump has still got a lot of support, and certainly what he's doing with his pro-business agenda has revitalized the American corporate area. There's a lot more investment in putting on more people, in investing in the businesses. So I think there's a very different corporate attitude in America now, and that's been positive and that's been very healthy. For most investors, well, for all investors, it's all about your plan. That's where your confidence and your calmness comes from. If you are anxious about what's going on in the market, then clearly you are not on top of your plan to the degree that you need to be, because to me, the markets are quite clear-cut at the moment, and I'm quite calm and relaxed about what's going on. Investors who are undecided don't really have a plan. I think it's as simple as that. And if you continue to try and bumble along without sitting down and formulating a plan, then you're going to continue to be in this awkward situation of you're not quite sure what to do, whether to stay in high levels of cash or just what to do. Your plan needs to be in the context of evolving markets, and markets do evolve. So your plan should never ever be fixed and rigid. It should be flexible. It's unrealistic to think that what you were doing 3 years ago is still applicable now. And what you're doing now, even if you've got a really good plan, if you stick with that for the next 3 to 5 years, then you'll probably find that it's no longer appropriate. So you certainly need to be dynamic in your outlook. There are natural sector rotations going on all the time, constantly. And so to best utilize your capital, to use it efficiently, then you need to be aware of where those natural sector rotations are. So to wrap it up, to me, this remains a buy the dips environment. But only where the earnings growth is occurring. We're seeing substantial differences between sectors in terms of where the growth is. Understand where the growth is, which is what I endeavour to provide for members constantly. And if you buy the dips in those sectors where that earnings growth is strong and where the outlook is strong, then I think you're going to be in pretty good shape. So that wraps it up for this week. There's my contact details for anyone that who's a non-member who wishes to communicate with me. Now, last week I mentioned that I was going to do a video based around questions that I'd got, which was around the relevance of past performance figures. Now, that video was done. However, one of my admin staff was ill during the week, who assists me with the production of that video. So that video will just be delayed just a little bit, but I will get back to you with that. And if you are not subscribing to the current video series, then just jump on our website and you'll be able to tap into that. A lot of valuable information in that series. That's it for this week. Cheers.